Hello everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about Treasury Management, which is Module C of the Bank Financial Management book of CAIIB. Now in this video, we will be covering the entire module of Treasury Management. This video will be very informative and will have all the important points which you need to remember to pass this module. So if you like this video, you can press the like button, subscribe to our channel and share it on social media. So if you have clicked to watch this video, be rest assured you have checked a channel that will give you treasure of knowledge. That's a promise. So please subscribe and become a lifetime learner. Thanks for subscribing our channel. Now, an overview of integrated treasury function. Now, treasury is all about dealing with assets, which could be in the form of SLR, CRR, equity, venture funds, funds management, rising of tier 2 capital, corporate debt, debentures, derivatives, foreign exchange, call, notice, term money, commercial paper, front office, mid office, back office. So these are an improved or integrated version of the treasury function. Now, what are certain reserve requirements as per RBI? Now, SLR is the statutory liquidity ratio which you need to maintain with RBI under Section 24 of Banking Regulation Act 1949. This is important. Now, CRR has to be maintained under Section 42(2) of RBI Act 1934 and Section 24(2)(a) of Banking Regulation Act. Many a times in the question paper, you will directly be asked the sections under which SLR and CRR has to be kept with RBI. Now, if you talk about CRR, maintenance of cash reserve ratio is with scheduled commercial banks required to maintain with RBI on average cash balance of not less than 4% of net demand and time liabilities on fortnightly basis, and RBI can increase the same not exceeding to 20%. Now, liabilities not to be included in net demand and time liability is paid up capital, credit balance in profit and loss account, refinance from RBI, refinance from Exim Bank, IDBI, NABARD, National Housing Bank, SIDBI, amount of provision made for IT in excess of actual estimated liabilities, DICGC claim received from ECGC, amount received from insurance companies, interbank term deposit borrowing with original maturity of 15 days and above up to 1 year. So these are the liabilities which you cannot include in net demand and time liabilities, hence not include in CRR. Now, what is SLR? As per Section 24 of Banking Regulations, scheduled commercial banks are required to maintain cash or gold valued at price not exceeding the current market price, or in unencumbered approved securities valued at a price specified by Reserve Bank from time to time. An amount of 19% of demand and time liabilities is the SLR requirement at present. Procedure for calculation is same except the interbank deposit and interbank loans of 15 days to 1 year are included. Now, what is call market? Now, instruments are completely unsecured. So, call market is a market where you can raise funds for a very short period of time. So, in this, the instruments of call market are completely unsecured, but they are highly liquid. This platform is provided by CCIL under the aegis of RBI. It indicates the rate of short term lending of funds to commercial bank, cooperative banks, and primary dealers. Now, what is CBLO? Now, it's a product which has been developed by CCIL for the benefits of entities who have restricted participation in terms of ceiling on call borrowing and lending borrowing, or who do not have access to call money market. Now, CBLO is discounted instrument available in electronic book entry from their maturity period ranging from 1 day and above. Now, borrower is under obligation to return the money that he has borrowed at specified future date. As an underlying charge, securities are held in custody with CCIL. Eligible securities are central government securities including treasury bill as specified by CCIL from time to time. Now, if we talk about accounting, net funds obligation comprising the member wise pay in pay out position is sent electronically to RBI for effecting debits and credits in the member current accounts through the settlement account of CCIL. Now, RBI completes the settlement and sends fund settlement confirmation to CCIL. After receiving settlement confirmation, CCIL posts the CBLO to the respective member's CBLO account. Now, what are government securities? Now, primary market, two types of auctions are held by RBI: price based and yield based. Now, RBI pre-specified an approximate amount of dated security that it intends to issue through a given year. Now, certificate of deposit is a negotiable money market instrument and is issued in dematerialized form or as an issuance promissory note for funds deposited at a bank or other eligible financial institutions for a specified time period. Now, guidelines for issue of commercial certificate of deposit are presently governed by various directives issued by Reserve Bank of India. Now, for an institution to be eligible, certificate of deposit can be issued by a scheduled commercial banks, excluding regional rural banks and local area banks. Select all India financial institutions that have been permitted by RBI to raise short-term resources within the umbrella limit fixed by RBI. Now, banks have the freedom to issue certificate of deposit depending upon their requirement, and financial institution may issue certificate of deposit within the overall umbrella limit fixed by RBI. That is, issue of certificate of deposit together with other instrument with term money, term deposit, commercial papers, and intercorporate deposit should not exceed 100% of its net owned funds as per the latest audited balance sheet. Now, minimum size of issuance of denomination, minimum amount of certificate of deposit should be 1 lakh. That is, minimum deposit that can be accepted from a single subscriber should not be less than 1 lakh and in the multiples of 1 lakh thereof. Who can subscribe? Certificate of deposit can be issued to individuals, corporation, companies, trust funds, associations, etc. Non-resident Indians may also subscribe to certificate of deposit, but only on a non-repatriable basis, which should be clearly stated on the certificate. Such certificate of deposits can be endorsed by another NRI in the secondary market. Now, the maturity period of certificate of deposit issued by bank should not be less than 7 days and should not be more than 1 year. The financial institution can issue certificate of deposit for period not less than 1 year and not exceeding 3 years from the date of issue. Now, discount or coupon rate is the certificate of deposit may be issued at a discount on face value. The issuing bank financial institutions are free to determine the discount and coupon rate. So the reserve requirements, bank have to maintain appropriate reserve requirement, that is cash reserve ratio and statutory liquidity ratio on the issue price of the certificate of deposit. Transferability, physical certificate of deposits are freely transferable by endorsement and delivery. Dematted certificate of deposit can be transferred as per the procedures applicable to the other demat securities. There is no lock-in period for the certificate of deposits. Now, loans or buybacks, banks, financial institutions cannot grant loan against certificate of deposits. Furthermore, they cannot buy back their own certificate of deposit before maturity. Now, commercial paper is an unsecured money market instrument issued in the form of promissory note. Commercial paper as a privately placed instrument was introduced in India in 1990 with the view to enable highly rated corporate borrowers to diversify their source of short-term borrowings and to provide an additional instrument to investors. Subsequently, primary dealers and all India financial institutions were also permitted to issue commercial papers to enable them to meet their short-term funding requirement for their operations. Now, who can issue commercial paper? Corporates, primary dealers, and all India financial institutions that have been permitted to raise short-term resources under the umbrella limit fixed by RBI are eligible to issue commercial papers. So, a corporate would be eligible to issue commercial paper provided the tangible net worth of the company as per the latest audited balance sheet is not less than 4 crores. The company has been sanctioned working capital limit by bank or all India financial institution. C. The borrower account of the company is classified as standard asset by financing bank institution. Now, all participants shall obtain the credit rating for issuance of commercial paper from either Credit Rating Information Services of India or Investment Information Credit Rating Agency of India or Credit Analysis Research CAIIB Fitch Rating or such other rating as agency may be specified by Reserve Bank of India from time to time. Now, maturity of commercial paper can be issued for between a period of 7 days and maximum up to 1 year from the date of issue. The maturity date of commercial paper should not go beyond the date up to which the credit rating of the issuer is valid. Commercial paper can be issued in the denomination of rupees 5 lakh or multiple thereof. Amount invested by single investor should not be less than 5 lakh face value. Now, commercial paper may be issued to and held by individuals, banking companies, other non-corporate bodies, registered or incorporated in India, unincorporated bodies, non-resident Indians, and foreign institutional investors. However, investment by FIIs would be within the limit sets for the investment by Securities and Exchange Board of India. Now, mode of issuance: commercial paper can be issued either in the form of promissory note or in a dematerialized form through any of the depositories approved by and registered with SEBI. Commercial paper will be issued at a discount to face value as may be determined by the issuer. Now we need to understand some of the basic terminologies issued in the Treasury: coupon, maturity, current yield, yield to maturity, duration, measure of central tendency, measure of dispersion, variance, standard deviation, and value at risk. Now, a current yield of 10% bond, 12% coupon with par value of 1000 selling for 950. What is the current yield? You need to know the formula to calculate this. Bond value 1000, coupon 10%, maturity 5 years, current market interest 8%. What is the bond price? So this is how you can calculate it. Stock returns of the company are as under. What is the standard deviation? You need to calculate the standard deviation from the given information. Now this is the fluctuating interest rate, which is yield curve. Yield curve parallel shifts. What are different rates of interest? Mm, Stiffening and flattening. Now let's talk about duration analysis. It is a methodology which is required for following purposes: to assess asset liability mismatch between assets and liabilities, to compare two portfolios, both can be assets or liabilities, or one asset and one liability portfolio, to decide between various options for contracting assets or liabilities. Duration analysis is done. In financial analysis, any intermittent cash flow earned from the financial asset is presumed to be reinvested at current interest rate. Thus, when current interest rate goes up, price of a bond falls with the reinvestment income will go up for period of maturity. Thus, capital loss and higher income occur together. At some point of time in the life of asset, the capital loss will be equal to the rise in reinvestment income. This point of time is defined as duration of the asset. Now, duration is also termed as effective life of an asset, liability, or as weighted average life. Duration can be applied to any asset liability that is of fixed income type. It cannot be applied to floating rate instruments. Duration is a direct outcome of maturity to terms and interest rates. Hence, duration is also viewed as primary measurement of price sensitivity. Duration measure is expressed in years. So, duration analysis, this is an example. Duration is expressed in years and it is comparable across portfolios. Duration is a zero coupon bond and is equal to the maturity. Duration is additive. Hence, duration of all portfolios is the weighted average duration of all the instruments of the portfolio. Duration of a coupon paying bond asset is less than its maturity. Longer the maturity of a bond, longer is the duration. Duration is inversely related to coupon. Now, duration is directly related to market interest rate or yield. Higher the frequency of coupons, lower is the duration. Duration of a floating rate bond is equal to its interest reset period for the period remaining to be next reset for the interest. For small changes in yield, duration multiplied by percentage change in yield gives percentage change in price for bonds. So if current price of bond is 98.50, its duration is 2.76 and yield is likely to change from 6% to 5.8%, then the likely price of the bond is computed as under. So duration, I'm sorry, duration is not preferred to compute price changes when change in yield is large. For this purpose, modified duration is used. Now the formula of modified duration is duration upon 1 plus yield. In our bond example, D is equal to 2.76 and yield is 6%. Therefore, MD is equal to this. Uh, so you can calculate. This is the duration gap is the difference between the duration of asset less the effective duration of liabilities. This is a numerical which you can just stop and pause and go through it. So you have reached the end of this video. Be rest assured you have reached a channel that will give you a treasure of knowledge. And that's a promise. So please subscribe and become a lifetime learner. You'll be getting many more valuable videos on CAIIB. Thank you. Have a great day. Bye bye.